Ever wondered how to measure the sensitivity of an option's price? Well, it's all about understanding the option Greeks: delta, gamma, theta, and vega. These are sophisticated tools that traders use to predict the behavior of an option's price in relation to various factors. Each Greek represents a different aspect of an option's price sensitivity. Delta measures the rate of change in an option's price relative to a $1 move in the underlying asset. Gamma, on the other hand, measures the rate of change in delta. Theta represents the rate of decline in the value of an option due to the passage of time. Finally, vega measures the sensitivity of an option's price to changes in volatility. Understanding these Greeks is crucial for managing risk and maximizing returns in option trading. So, buckle up as we dive into the world of option Greeks. First up, we have delta, the most sensitive of the Greeks. Now, what does delta really represent? Picture this: you're watching the price of an option as the price of the underlying asset changes. Delta is there, diligently measuring the rate of this change for every single unit change in the price of the asset. Imagine delta as a speedometer in your car, gauging the speed of change in the option's price. If our speedometer, or delta, reads 1, it means the option's price moves in unison with the asset price. If it reads half, the option's price moves half as fast. Quite intriguing, isn't it? Delta is a powerful tool in your financial arsenal. It can help you understand and predict how an option's price will react to market movements, allowing you to make informed decisions and manage risk effectively. Just like the speedometer in your car, delta helps you steer your financial journey. Remember, delta is all about the change. It's the Greek you'll need when predicting price movements. Next, we're tackling gamma, the second derivative of an option's price. If delta is the speed at which option prices change, then think of gamma as the acceleration. Gamma measures how quickly delta changes with respect to changes in the underlying asset's price. Imagine driving a car. Delta is your speed, the rate at which you're moving forward. But gamma is your acceleration, the rate at which your speed itself is changing. If you're driving at a steady speed, your gamma is 0. But if you're speeding up or slowing down, your gamma is in play. So, when you're dealing with options, gamma is an essential Greek to understand because it helps you predict how delta, and thus the option's price, will change as the price of the underlying asset changes. It's like having a heads-up display for your financial highway. So, gamma is a measure of acceleration. It's the Greek that helps you understand how quickly delta is changing. Now let's talk about theta, the time decay of an option's price. You see, theta is a tad bit like a ticking time bomb in the world of options trading. It measures the rate of change in an option's price for a 1-unit change in time, which is typically 1 day. Think of it this way. If you're holding an option and each day you're losing a little bit of its value, that's theta working its magic. Theta is often referred to as time decay because, well, it represents the erosion of the value of an option. As time passes, it's a crucial element for any options trader to understand because it directly impacts your potential return on investment. So let's say you're an option buyer. The clock is your enemy. Each passing day is chipping away at your option's value, but if you're an option seller, time is your friend. Each passing day brings you closer to pocketing the full premium. Theta is about time. Remember, as time passes, the value of an option decreases, and that's what theta measures. Finally, we come to vega, the volatility player in the options market. Vega is a bit of an outlier among the Greeks. It's the only one that isn't named after an actual Greek letter. But don't let that trick you into underestimating its importance. Vega is all about volatility, and as any seasoned trader will tell you, volatility can be a game changer. So, what does vega do? It measures the rate of change in an option's price for a 1-unit change in the volatility of the underlying asset. In other words, it tells you how much the price of an option will move if the volatility of the underlying asset changes by 1%. This is crucial because volatility is a key factor that affects options pricing. Imagine you're holding an option. If the volatility of the underlying asset increases, the option becomes riskier, right? And risk equals potential reward. So the price of the option goes up. Conversely, if volatility decreases, the option becomes less risky and its price drops. That's vega at work. Vega is particularly important when you're dealing with options that have a long time until expiration. These options are more sensitive to changes in volatility, so vega plays a bigger role. So vega is your volatility tool. It's the Greek you'll need when assessing the impact of volatility on an option's price. Now that we've covered all the Greeks, it's time to bring it all together. We started our journey with delta, the warrior of direction, showing us how option prices move with changes in the underlying asset's price. Remember, delta is never stagnant, it's always on the move, adjusting itself with every tick of the market. Next we met gamma, the guardian of acceleration. Gamma gives us a measure of how fast delta is changing, helping us predict future movements and make more informed decisions. Then we encountered theta, the timekeeper. Theta keeps track of time decay, reminding us that each passing day chips away at the value of our options. The closer we get to expiration, the more important theta becomes. Finally, we were introduced to vega, the whisperer of volatility. Vega gauges the sensitivity of our options to changes in market volatility. When the market gets shaky, vega is there to tell us how our option prices might react. Understanding these Greeks is crucial for managing risk and maximizing returns in option trading. They're tools in your toolbox, ready to guide you through the complexities of the market. By comprehending each Greek's personality and purpose, you're better equipped to navigate the often turbulent waters of options trading. So there you have it, a complete guide to understanding option Greeks. Don't forget to comment, like, and subscribe for more insightful financial content. Until next time, keep trading smart.